Stocks picked up the pace towards the end of the day today, ended up with another strong move as we enter into another important week of earnings. We're really starting to hit the earnings season strong and hard, going into what seasonally has been a bearish time of year for volatility, which is a bullish time of year for equities. So volatility has been following that season, continues to follow that seasonal pattern, and the markets have been moving higher today. Small range, small volume. That's not surprising. We'll take a look at some of the moves that it's had, some of the technical patterns that it's showing. We had been in convergence mode. It's transitioning towards a new impulse move without a consolidation. So now that brings up the question of how long will the new impulse move last before we start another convergence. So we'll talk about that, some lingering technical signs from last week that haven't resolved themselves yet. We'll talk about what those are as well. We'll take a look at the major moves in different asset classes and what's kind of moving a lot of this risk appetite right now, and especially from a sector standpoint. And then we'll take a look at our trade idea of a stock that has had its own consolidation pattern. And we'll talk about how to trade it as it potentially may be through with it, and as it starts its own new impulse move. So let's go ahead and get started. Today is Monday, July 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching on our blog, check out some of these things over here on the right, including our Market Outlook live video. Scroll down here to the bottom, click on this heart. It opens up this tab, hit that like button. Same thing here, click on this thumbs up icon. It opens up that tab, hit that like button there. Again, the more you do that, it helps get our content out to all of our followers. So thank you. We almost got to 100 there. That's our goal every time. So thank you to those who click on that day in and day out. Those who don't, you can do right now with one or two really easy clicks, and it would go a long way for us, and we really appreciate it. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Your intermediate line now up to the 95th percentile, so very strong posture. Market sentiment line is in the 83rd percentile and rising. So reflecting obviously the strong trend we've been on pretty much since the end of March, but especially since this last bull tag you had bounce signal there at the end of May. So we're going on nearly 2 months since we've had that signal, and that was a continuation pattern. We're now going on, 4 months now of this intermediate run that we've been on since that last bear tag that typically kicks these things off. When you look at the short-term sentiment, the momentum line is still in bearish territory. We're not getting very big ranges. We're getting a new 52-week high, but we're not, like, the range is still really small, way below like 1%. 1% being 45 points. The ATR is below 1%, and then we're well below that. So not surprising, a Monday of earnings season where there's not very many earnings coming out. You tend to get a quiet day. The short term, the near term line is down from where it was, so it was in the upper reversal zone. You got a little bit of a divergence going on. The first near term peak got above the 90th percentile. The second didn't, and then obviously, so even though you got lower highs, you got higher highs here. So obviously a break below the low in between would signal a change in trend. That's how near-term divergences work. That'd be a target. This little pullback right here would be a target based on just the divergence alone, nothing else. And of course, a break below that. Of course, if you were to hit that target, you'd basically be getting another bull tag. And then the question is whether it would be a bounce signal again. 4 months into the current run, which the intermediate rallies typically last 1 to 3 months. So we're in the 4 now. So if that happens, will that bull tag be the beginning of an intermediate decline like the last 3, or those other 3, or these 2, a continuation pattern? Now we are 3% above the moving average down there, so we've got a good bullish move. It is, most of the other indexes are following suit. The Dow is trying to get to a new high. It's right there, 34,585, 34,589. I mean, we're right there for a new closing high. We're not quite getting it today. The intermediate line well into the upper reversal zone above the 90th percentile now. momentum line bounced out a little bit closer to the average range. The near-term line still in bullish territory. Market sentiment's not as bullish, reflecting that we haven't been as bullish here. The current intermediate run started with that bull tag at the beginning of June. So we're really only a month and a half into this one, whereas remember the S&P is 4 months into theirs. So a little bit of difference there. The NASDAQ, not surprising, the biggest winner. Its last bull tag was at the end of April. The intermediate run started over here on March 16th on that move to the upside. So that's middle of March. I mean, we are 4 months now along in this one. So a very strong move higher to the upside. Strong bullish posture, intermediate line, long-term market sentiment line, even your near-term line still hovering right around the 80th percentile as your momentum line stays in bearish territory because, again, a much smaller range. Let's take a look at Russell. Russell had a really good day today, up over 1%, a little off of its highs. Thus, its momentum line was the strongest out of all the indexes, jumped all the way back above 80, just as the near-term line was closing out of bullish territory, just barely there. I remember it had a much bigger gap last week, had a very strong week last week here, a little pullback at the end of the week, but before that, a very, very strong week. Big gap on Wednesday there that we still haven't really filled in yet, and then still holding that move today. Remember, we're not, the difference here, market sentiment line is not as bullish. It's just barely getting into bullish territory. We're not near, we're well above the August and February peaks on the other indexes. We're not yet here, so it's still way in catch-up mode, and you have some opportunity for some short gains. Not very much, but some short gains. If you look at the ratio between the Qs and IWM, we started to pull back, ended up staying above these moving averages by the close today. But you can see we've been converging as we've been rallying. We've been converging on these oscillators. They're all dropping. They're also below the moving averages. We got the crossover on that long term. So the question is just how much longer something that's highly correlated, as you can see, with the S&P 500 will remain at these elevated levels. It's kind of hard for the markets to do well with the Russell going up and the NASDAQ not, at least going up at a smaller degree, considering the wide. I mean, Apple by itself has got the market cap of the Russell 2000 practically. So it's going to be hard for the Russell to go up and lead the market higher when you have such disparities in market capitalization. Let's take a look at the long term. So again, we're watching these highs and closes, much higher close, so that's not an issue. The high is actually slightly higher too, so that's really not an issue either. And you can see the size of the candle is still pretty elevated, back above its moving average after some convergence we've had. The PPO is almost back to 5%, so it's almost back to those pre-correction levels that we had. So it's a pretty strong level considering a trend. You can see kind of where I'm at right now. So if you follow my cursor to the left, this is a pretty elevated level for how strong this golden cross environment that we're in right now. Golden cross being the 10-week up above the 40-week. So we'll keep our eyes on that strength. Obviously, you still have 3 green arrows for a third day across all the major indexes, 4 for the Dow and 5 for the Russell. But 3 now for the S&P. So that's a pretty good move. Like we've been able to hold on. It doesn't look like we're going to get a red arrow anytime soon, especially not on the moving average, but not even on the MACD or the stochastics. So we're probably going to end up with some 3 green arrows for quite a while, for at least a few more days. So that's a good sign for the market in terms of kind of re-engaging a new impulse move to the upside. MACD is up above its moving average. It's right. The moving average is rising. You're well above the 17-day. In fact, when you look at, just how far above the 17-day moving average we are right now, it's a pretty decent level, like up 2% above the 17-day moving average. You can kind of get an idea. It's not the highest, 75th percentile, but still, it's a pretty decent. It's upper quartile, not quite the upper decile, which is what gets you these dots here. But remember too, it's not like we're starting a new trend. You tend to get your strongest momentum moves early, and then when you get these kind of similar momentum moves late, they tend to be kind of exhaustion type levels. And we're actually still underneath that June expiration peak. where we did hit an exhaustion point right around 3.33% there. Let's take a look at some of the other oscillators. The DMI, the positive indicator, is still above 40. It doesn't stay above 40 for very long. Remember, it did get above there also at that June expiration. Did not get above. We know it's one thing to get above 40, but if we can get above this high, that would have been great, but we're not. It's still a lower high, and again, very overbought from that standpoint. It does not stay above 40 for very long, and we are at least back above the ADX, and the ADX is at its highest level, as the negative indicator forms higher lows, so it's not forming new lower lows after hitting an extreme again at that June expiration peak, that exhaustion gap. We are still above 70, again another extreme, in this case for the RSI, while the CCI itself is forming a divergence still. We're not getting back up above that in this case the early July peak, much less the June exhaustion peak, the June expiration peak. This would be actually the June 30th, the end of the quarter kind of exhaustion move that we had. So you're still showing signs of extreme, like when you're at the 97th percentile of the bandwidth, that's actually starting to increase. You're still well above the Keltner channel. You still got, you're still at that's a high level. Again, that's a pretty good move to be above the Bollinger Bands when you're starting an intermediate rally. In this case, coming here in April, when you're at the beginning stages and you're getting up above Keltner channels and things. But when you're already 4 months in and you're getting moves outside the bandwidth, that's a little bit of an extreme. Again, you're kind of adding to a lot of extremes at this point. Your Arun indicator is still bullish. Again, we got a new 4-week high point today. We're not really expanding the size of the channel. We're still below 5%. So we are pushing gradually up to new highs, though they're not very significantly higher, and that low point is still going to be there for quite a while. It jumped up here, and it's now it's gradually moving day by day until we get a new low point. It's going to move back to zero. Remember, we don't really get concerned about a new change in trend until the green chops back below 70. And the fact that we've already had 2 dips below 70 already, again, sets you up for that idea that a change may be coming. Again, another sign of exhaustion, of extremes, when you get multiple dips below 70 without the change in trend. Usually when you're on a nice, good, long, bullish pattern, as you can see when you go back to some of these other bullish patterns here, you don't dip below 70. You dip, but you don't dip below 70. You dip below 70 once, then you get your change in trend. You can see you dip below 70s when you get your change in trends, but you typically don't dip. Here you dip below 70 a couple of times, just barely, but then you ramp right back up. And the same thing over here, you're bullish for that long with no dips below 70. And the fact that we've had 2 already without the change in trend means that we need to be really on vigilance of that to be coming up soon. Again, sooner rather than later, as especially when you look at the gaps here, these common gaps that still haven't filled in yet. We're still well above the value area. Not a lot of support below us because of how quickly we moved, and doing a lot of it after hours. So let's watch for higher high and a higher low. We ended up closing slightly below yesterday, or Friday's high, which was last week's high. This can get filled in quickly. That can get filled in really quickly. And now we start looking, for this exhaustion to play itself out into more of that convergence pattern that we have been having, that we've been on for the last few weeks, and then finally turning actually into a consolidation, considering we are kind of past the time of the norm for the intermediate rallies. I told you today's range was really small. It was way below the average, 2 points. The volume was also really light. If you look at the volume here, again, these are not indicative of expansions. These are indicative of very mature cycles. 52 million, way below the average, right? So way off, off the charts. Again, not surprising. Way below 1% on the average range. So we are really like mature in this trend. It's a nice, good, solid trend with the ATR at its 52-week lows on both an absolute and a normalized basis there. When you take a look at the volatility index, of course, you get a little bit of a jump higher, as we always do on Mondays. Close at the lows on Fridays, you jump up on Mondays. That's the case. But again, the VIX was actually up today, but again, only because it was a Monday, but down throughout the day. As you can see, the VVIX actually went up today, was up as well, and that correlation is back below 50% again, and it's threatening to get back below 0% again, and even worse potentially. And again, the VVIX is well off of these VIX. It's low here from the end of June. The VVIX is well off its lows. The VIX itself is not. It's actually kind of slightly lower low than what we had at the end of June. So big divergence that's playing out there, and we've been talking about the seasonality of the VIX. It is seasonally bearish this time of year, so this is the type of move we typically get going into the end of July. The markets have a little seasonal rally, and we're having more than just a little seasonal rally, and that's bringing the VIX down. But at this point, at the end of about a week from now, is when the VIX bottoms out, typically. After we've gone through a big chunk of the earnings cycle, and then volatility rallies up to new highs by the end of October. So you end up with typically a volatile, you tend to get more volatility in August, September, and October. A little bit of a reprieve in the middle of September, but going into October, a little bit of a reprieve there as well, before finishing again at the high of the cycle at the very end of October, beginning of November. So we're going into that, as we have been for quite some time, with a volatility index showing multiple signs of extreme lows, whether it's compression, whether it's how low it is on an absolute basis here, in this case below the 200-day moving average, how low it is on a relative basis, relative to VIX 3M, and how low it is on a with this in terms of what the correlations are telling us between the S&P, as you saw earlier, and then now the VVIX. I mean, all of these are suggesting the VVIX, and really even too when you look at the skew, all of these things, the skew being near this 150 level, hitting back to 149 today. I mean, it doesn't seem so high because 2021 kind of skewed what is the norms for the skew index. But if you look at what is traditionally the high point, 150 is very high, as you saw in 2018. Again, thrown off by 2021 because the Fed just wouldn't raise rates, even though inflation was taking off. And so the market was anticipating this correction a little earlier because, again, the Fed waited so long to act on what the markets were expecting. But you can see, again, we are right back there at the 150 level on skew. So the markets, again, are still concerned about not just an intermediate pullback, but another correction. The intermediate pullbacks, the skews get up to about 130 or so. But to get up to 150, that's a significant move to the upside. I mean, the market's expecting more than just a little 23, 38% retracement. At least the options market, that is. All right, now let's talk about what's driving a lot of this price action. You can see, again, this 20% return that the Qs have been on. If you look at the rolling, if I were to do the rate of change and just look at that rolling 3-day window, so let's go 63 days, or 3-month window, excuse me. Look at 63 days and pull up NDX here. You can see, again, it's been above 20%, or right since getting to that point. Towards the end of May, it got up to right at 18.5%, eventually got up to almost 20% there, and then eventually clipped 20% over here at the beginning of June. And it's been up around there all this entire time. It also got up there at the end of March when this whole intermediate run started, and it's been up there since. So a very, very good rally. You can see, again, if I zoom out for some context on this length of time, it's been above zero. It's a pretty good length of time. Now, even over here in 2021, you had multiple dips below zero on the 3-month returns on these intermediate declines. In 2019, which was a really bullish year, you had multiple dips. Here we are now for most of 2021, going on 7.5 or going on 7 months, 6.5 months. and not a single dip yet below zero. Almost over here in March, with the right when the banking crisis was kind of going through, the regional banking crisis. And then, of course, again here at the beginning of May when we were just sideways, right? Not very much of a decline at all. So you see, it's not like this kind of run is pretty decently. It's a pretty strong move. Like COVID coming off the COVID lows was a very similar type move. Again, you had a little bit of an intermediate dip there that got you to zero because you were so strong. But 20, if you look at 20, follow my cursor along, that's a pretty good run. That's a pretty good 3-month return, historically speaking, especially considering that the VIX isn't nearly as high as it has been. To produce this run, it's one thing when the VIX is really high to produce that run coming off of these, coming off of this July or even the October lows, but the VIX hasn't been that high here in March or even especially in May, and we continue to get that kind of a move to the upside. So strong rally, and you see that here. If you look at just today alone, let's go down to July the 17th here. If you look at just today alone, the Qs were underperforming for a good chunk of the day, caught up at the very end. So your Qs and IWM were both up 1%, way outpacing the broader market, which was only up 1/3%. So it's kind of an interesting development there. And then on the other end of the spectrum, your real estate and commodities, both, so hard assets, both down pretty significantly, despite a weakness in the dollar. It's one thing for the dollar to be bullish and put pressure on commodities, but commodities have really come down here today. Now, granted, they've been pretty bullish in the wake of a very strong move to the downside in the dollar, but the dollar hasn't bounced up. It's been flat. It hasn't bounced up, and your commodities are starting to feel a little bit of the little weight of the fact that the dollar is not dropping anymore. And it's pulling back still above the 8-day moving average. So it's like not that big of a pullback. Of course, the biggest component is the crude oil, which is it's hit that 200-day moving average, hit the point of control for the 1-year chart, and has moved back to the 8-day. The MACD stochastics pulling back, though the stochastics average is up in the upper reversal zone for only the second time this year, at least as far up as it has been. So it's not. It's one of the bigger, stronger moves that we've had. I wouldn't put a lot of stock into this 2-day decline yet. Again, as it appears to be just the fact that yields aren't rising or aren't dropping anymore. You can see yields stay pretty flat. They've been dropping along with that dollar. If you take a look at the FOMC here, let's go to the FOMC chart again. A lot of this dollar weakness coincided, especially here, with a significant drop from the 5% level on the 2-year yield. The 2-year yield still right around the 4.75%. If I were to zoom out a little bit, you can see the big jump that we had on Friday here. The big jump on Friday, flat today. But the 3-month is the one that's kind of more reflective of what the Fed's going to do. And this hasn't moved at all through the ups or the downs. It's been about as flat as can be since that June 5th peak. June 5th right here is where the 2-year and the 10-year peaked. Then they've been dropping ever since. 10-year dropping from the 4% mark here on June 5th, and then again another little peak on the 7th. But the 3-month is still holding in. 98% chance of a rate hike in July. Of course, the big factor will be what happens, whether we get the second one. And the second one, the odds really dropped down today from where they were. They were nearly 25%, which was also a decent drop from 32. But now the odds of a second rate hike are only 13%. The odds of a rate cut also dropped down from where they had been to only 5%. So basically cut in half. So you can see the odds of being at 5.5%. Have ramped up all the way to 81% now with declining odds of rate hikes, declining odds of rate cuts that will just be right here at 5.5%. So interesting move on bonds. Here lately, the bonds TLT rising towards its point of control, towards some of these moving averages. Of course, the the significant pattern for TLT is if and when it will ever jump back above, the 50, 30-week moving average, which is essentially sitting right on top of each other, right at the point of control. So a major level of resistance. The MACD on the weekly chart here trying to climb up, converging. You can see we had the kind of breakdown, ended up being a little bit of a false fake out type pattern as we immediately bounce back up here. And now the question is, what do we do today? So that, or what do we do this week? Do we get back above the 17-week? Do we try to work our way back above the 30 and the 50, kind of like we did back over here in early April? That's the big pattern, because you break into this gap, markets are not going to be bullish with TLT breaking up through this gap here. More than likely, you can see again during this inflationary time frame that we've been on, TLT has been falling as we've been inflationary. If it just jumps back up to the upside now, with the correlations between TLT and the stock market returning back to kind of the norms here of bonds and stocks moving back up. Let's see, let's transition this out to a longer time frame. Stocks and bonds in a deflationary environment tend to be negatively correlated, and you can see that's been, it's kind of, after being positively correlated for a long time here, it's returning back to what it normally is. So if bonds rally, stocks won't rally along with it. More likely than not, they won't rally along with it. It'll be an environment of risk aversion, not risk appetite. Obviously, in an inflationary environment, if there's people willing to take risk, bonds and stocks would both rally to the upside. But considering obviously that we're not nearly as inflationary as we were in 2022, and even if inflation does ramp up, which I expect it will, it's not going to ramp back up to 7 or 8. I think the Fed will start to raise rates again if they need to. They didn't cut rates. They won't cut rates. So I don't think necessarily inflation will ramp back up, though I do think it is very likely it ramps back up towards 4 or maybe a little bit more than 4 by the end of the year, as the significant 1% increases now are all off the table, and now we continue to get 0.2, 0.3, 0.4% increases month over month. That generally trends towards a 4.5% year-over-year inflation rate, which is, even just at 3, is historically a very high level for a Fed who wants to get it and keep it at 2 or less. Let's take a look at how the sectors perform. So give me 1 second to pull up the sectors here today. The sector grid is a sea of green, so we do have green shading all across the board now. Green shading and green lines all across the board. So considering again that the implied correlations are at their lowest level since the end of 2017, beginning of 18, and that's when we had that big February 2018 drop. So really low correlations, but you have pretty much everything at least showing decently bullish patterns on their market forecast charts. When you look at the comparison, again, over the last 3 months, it's been a magnificent 7 world, and we're all just kind of living in it. Industrials trying to tag along there. If I just look at today alone, so let's come down here to July and just look at today alone here. You can see today, technology and financials ended up being this. This is earnings season. Financials really starting off the season relatively strong, and earnings or technology also doing well. You can see industrials has been kind of matching the S&P's gains. Consumer discretionary doing well today, kind of picking up the pace late. Communication services, however, underperforming, along with real estate and utilities, 2 of your safe haven areas that are probably the most sensitive to interest rate increases. As interest rates increase, it makes their dividend yields less attractive versus when dividend interest rates are declining. So it makes more sense that you'll have that this little drop in yields is very temporary back to these old highs, and that you're more than likely going to ramp back up and get back above 4%. Now, last time we got to 4 on the 10-year and 5% on the 2-year, there seemed to be a pretty concerted effort to push on the dollar, and pushing on the dollar created the everything that we've seen in the market since then, right? If you go back to the asset class comparison and go back to that July 5th. So we peaked on July 5th on these yields, and so July 6th on, and how things are performed. You can see the dollar, as bearish as it's been, has produced bullish impacts on commodities, on gold, on all these different asset classes, U.S., international, all doing bullish, small caps. So that all benefited from the weakness in the dollar. This campaign was triggered by yields breaking those kind of big round numbers. But now they've pulled back and kind of stopped their pullback. And the question being is, will they get back to, especially with their these inverted yield curves as low as they are, 160 basis points on the 10-year to 3-month, which is a really, really low level. It's better to see that historical trend here. That's a very, very low level to be at 160 basis points, historically speaking. So again, being inverted is not bearish. In fact, it's actually pretty darn bullish, as we've seen, and all these other times too that it's been inverted. Markets are bullish as it's inverting. As it uninverts, that's the bearish. So the fact that it's so negative, it's in and of itself is not bearish. It's the fact that when it does uninvert, now that you're at even deeper levels, just to get to zero, and it uninverts pretty quickly. When it uninverts, that's when the markets tend to be bearish, as it's uninverting. And so when you're building up as much potential energy as long as we've been inverted and as deep as we've been inverted, it sets us up for an uninversion that might not be nearly as comfortable. You can see even the 10-2s are more inverted at nearly 100 basis points at its lows than what we've seen since the early 80s, late 70s, when the Fed was raising rates, up to, not 5%, though, may feel like that. For back then, it was up towards 20%, multiple times, getting up to 20% to combat just how significantly low that inverted yield curve was. And again, it's not the inversion, it's the uninversion that's not good for markets. And the fact that we're inverted for so long and so low builds up the potential energy of when we do actually uninvert. That ultimately converts itself to active energy in the markets, in this case, volatility, right? It would convert itself into volatility, which is not traditionally bullish for equities. It tends to be more bearish. All right, now let's take a look at our trade idea of the day. I want to take a look at AMD. AMD has been on this bearish pullback. It's been a nice, easy retracement down to about the 50% retracement at the lowest here. Not too significant. Like, you only had a couple of days of dark pink shading and a red line combined before the intermediate line turned back up again. And of course, the near-term line's been up above the intermediate line pretty much since the end of June. So it's been on this kind of convergence pattern, and now it's transitioning to more of a divergence pattern move to the upside, an impulse move to the upside, with the bear tag and clearing through the highest close in the last few weeks. You can see we're more than 1%, almost 1.5% up above the moving average. We've been getting multiple transition candles. This week is actually still a transition candle. At least they've gone positive, right? It's above its moving average, and they've gone above zero, even if we haven't necessarily started to move to the upside yet. Looking at the 3 green arrow chart, as you saw, we do have 3 green arrows. We crossed above the 30-day moving average. MACD has been above its moving average, so it's been green, but now it's above zero, which is a good sign. And not only is the stochastics has been green for a while, but it's in the bullish territory now. So you're getting pretty decent bullish patterns here on AMD. If you look at some of the other oscillators, you got a pretty, you're above 25 on the positive. You're not quite below 20 on the negative, but at least you're above 25 on the positive indicator. Your RSI and CCI are in bullish levels, above 50, working our way up towards 60, above zero, and we did get above positive 100 there. So good levels there. Looking at the Ichimoku cloud, we came down towards the cloud, held it for support, and now has since bounced back off of it. We've had a kind of a weak bullish trend. We're flirting with re-engaging right now. And then your Bollinger Bands, the stock ended up moving back into the upper quartile of the bandwidth have a really declining bandwidth that's moved inside the Keltner channels after this bearish pullback, like some of these other pullbacks. You got the red dots, and now you expect the momentum to shift from the downside to the upside. Doesn't mean it will, but you expect that it will. And so what we decided to do is come over here and look at an August bull call spread, long call vertical spread. So we're going to buy the at the money, which has the highest extrinsic value. That's how you define the at the money, the highest extrinsic value. And then we'll sell just one strike away. It happens to be $5 away, but it's just the one strike away. You can see we ended up position sizing for about half our normal position size, which is typical for a directional trade. These tend to be lower probability, and you're getting a little bit more than 1 to 1, almost a 2 to 1, but probably more like 1.5 to 1 reward to risk ratio. So more of a high probability directional trade, relatively speaking, right? Just in general, they're low probability, but this would be on the higher end. You can see how much space we have to work with. This is the 1 standard deviation cloud here between now and expiration. So if it were to pull back, that's how much room it has to pull back before a max gains is not that feasible anymore. So we have some flexibility and room to work with, and we give up reward potential for that flexibility. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow me on Twitter and Facebook. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.